You're an agribusiness executive navigating an increasingly competitive market while trying to grow your company. Mergers and acquisitions are pitched as an accelerant to growth, but many M&A deals destroy more value than they create. Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches for successful mergers and acquisitions. Here's your host, the Integration Pacesetter, Joe Mosier.
Hello and welcome to another episode of the Pacesetter Pod. I'm your host, Joe Mosier. Recently, I had the opportunity to attend an industry event here in Western Michigan. It was the Michigan Agribusiness Association's monthly Ag Club Breakfast in Lansing. This is a meeting that occurs most months of the year where members from academia, from the legislature, from industry, from other areas, industry associations, operators, etc., get together and discuss what's happening within their businesses today in the regulatory environment, upcoming legislation, challenges, etc. And it's a great meeting of the minds. And we had the opportunity to sponsor the breakfast and speak with members. And what we talked about in that discussion was that here as we enter the end of 2023, we're suddenly seeing a real uptick in optimism. We're seeing renewed deal appetite and all this interest bubbling up related to business capital investments and really some pretty bold declarative actions to say we're going to move forward on our strategy. It's kind of like coming out of a hunkering down year in 2023 with a lot of headwinds. So I don't know if this is just the energy of a new year. I don't know if this is the animal spirits taking a position as we shrug off the economy and shrug off the sluggishness of 2023. That part's unclear. But what is clear to me is that the conversations that we're having with our existing clients and with prospects, and what was echoed by many people I spoke to after the event, was that the conversations we're having are telling us something about what's coming. And what's coming has lessons for all of us. Whether you're beginning the process of exploring an exit and a sale of your business, whether you're getting in position to pursue an acquisition, or maybe if you're just wanting to make sure that you're able and ready to compete at the highest level as things take off, potentially take off in 24, this has lessons for us. For the investor community, what this has looked like for us is a flight to quality. And I'll talk about that more in a couple minutes, what that flight to quality means. But for everybody else, what's a flight to quality for the investor community looks a lot more like a return to rationality and getting back to basics as an operator. And so for today's episode, what I'd like to do is walk you through what we discussed at the Michigan Agribusiness Association's Ag Club Breakfast, and that'll focus on three things. It'll be a recap of what the last several years has entailed and what I believe is in front of us in the near term. Talk a little bit about the impact of that recent past and what that's likely to do to change future behaviors. And then talk specifically about what you need to be focusing on, regardless of your position, regardless if you're exploring a sale, acquisitions, if you're just looking to compete, regardless of your position and your strategic objectives, what you need to be thinking about and focusing on. And so with that introduction, let's dig in. So the first thing I want to do is I want to take us back to the start of where things got weird. And we're going to talk about calendar year 2020. And for each one of these next several years, I'm going to talk about one of the terms that we've heard that I believe was overused. I hope we never have to say again, though I will say them in today's episode. But let's go back to calendar year 2020. That was the year of unprecedented. This was the year where the pandemic set in, where we had government-imposed shutdowns. We had significant spending displacement as events, conferences, travel, hotels, food service, restaurants fell off a cliff. Meanwhile, retail spending at grocery stores and primary food providers skyrocketed. We had this great filling of the pantry as American households really overbought their needs. We had all the general turbulence around how do you plan for the future, not knowing if you're going to be operating, what operating looks like, what consumer demand is going to look like, when that demand will return, et cetera. And then we also had the challenge of, who's an essential business? And can you operate as an essential business if you can find the workers, et cetera? So 2020, there was a lot more than what I just recapped there, but it was the year of unprecedented. So that takes us into 2021. And this is the year that the terms are Delta and Omicron, right? So we got Delta early part of the year and Omicron in the later part of the year. But what happened in between was we started to see widespread shortages. And these are shortages beyond the big toilet paper rationing and hoarding of 2020, but we saw widespread shortages across the supply chain, in addition to just general supply chain disruption. As some parts of the country started to open up, as vaccines started to roll out, we started to see revenge spending. People who had been cooped up at home for too long, folks that had extra money in their pockets, folks that had a desire to go out and back and have experiences again and be out in the world, they really started to spend at a big rate. And then we also started to see, as a reaction to the shortages from the year before, we started to see the rebuilding of inventories and sometimes the overbuilding of inventory, kind of that overcorrection, if you will, following a period of disruption and displacement of supplies. And what also started to weigh on us was a persistent uncertainty, whether it was the change in administration in Washington, whether it was uncertainty around, would the pandemic get under control? What does a return to normal look like? Where are the workers? All of these things. That was the persistent uncertainty that really kind of weighed on us. So if we go into 2022, this is the year of transitory, another word that we probably overused and hopefully won't use again in the future. But if we think about 2022, the start of the year, we had the Black Sea conflict, of course, with Russia invading Ukraine. This was the year where we really fired up the printing presses at the Fed and opened up the hydrants of money and just poured money on the economy. At the same time, we had a persistent ZIRP dependency, or zero interest rate policy dependency, where artificially low rates were really starting to fund and maintain the economy. So when you have this excess liquidity that was dumped on the economy, combined with these zero interest rates, we started to see inflation pick up and then really rip. And that was, of course, the conversation around transitory. Is it a moment in time and it's likely to stop or retreat? Or is it here to stay? Is it becoming entrenched? We also started to see that real significant industrial overbuying. So at this point, the just-in-time inventory model became sort of the persona non grata. And this kind of contributed to a lot of the overstocking that we saw. And then towards the end, we saw the bullwhip effect. And I can't go into this in detail without taking up the entire episode, but the bullwhip effect, you should look it up. It refers to the long tail of risk and disruption that flows through a complicated or complex supply chain, as initially there's a drop in availability, then pretty quickly people overbuy their needs. The overbuying of the needs then creates a shortage of availability, which then persists again and again and again. It takes a few cycles before that kind of works its way through, before the whipping is done, as it were. And so we saw that really take effect in many parts of the ag supply chain in 2022. So 2023 was the year where we talked about a soft landing. Is it possible? Can the Fed actually navigate a cooling down of the economy without running it into the side of the mountain? Now, 2023 involved the regional bank failures, started with Silicon Valley Bank. We started to see a lot of destocking, primarily across the ag retail part of the supply chain. We started to see a renewed focus on working capital. And we also started to see disinflation. So not deflation where prices are actually dropping, but disinflation reflecting a slowing of the growth of inflation. At the same time, in the back half of the year, the Fed started to signal that we might have reached our terminal tightening rate, that maybe their battle with inflation was coming to an end. We still seem to have a gravity-defying economy despite the historically high interest rates, despite the very fast pace at which rates were raised. We still saw historically low unemployment, really high consumer spending, inflation continuing to hang in there. But that was a big piece of what the year was all about. And then, of course, as the Black Sea conflict persisted, in October, we had the conflict erupt in Israel with Hamas. And so kind of bringing to the fourth quarter a bit more instability, though still this discussion around soft landing. And so the last thing I want to say then is, given those 4 years, 2020, 21, 22, and then 23, which we're wrapping up here, what does that say for 2024? In a very simplistic, overly simplistic, perhaps reductive summary is, 2024 is a year of normalization, is what many are calling for. Now, normalization implies a return to normal. Is that the normal that we were experiencing in 2019? Or is that a normal that's more consistent with a longitudinal backward look? I think the topic here is that we don't exactly know what the normal is, though we do expect Perhaps normalization refers to the sentiment that we're going to return to some level of stability. We're likely to see a terminal destocking across the ag retail and the ag supply chain, though we'll see minimum inventory building on the back end of that. We're anticipating supply chain stabilization. There'll be more clarity around an assurance that people will be able to buy the inputs, buy the equipment, buy the supplies that they need to run their business, whether they're a producer, an intermediary, a manufacturer, whatever they might be within the space. There's a bit more of a forward confidence that what you need will be available. We've seen the very welcome return of the US dollar commodity inverse. Traditionally, the US dollar strength and commodity values have moved in opposite directions. In the past several years, they moved in tandem, which created all sorts of interesting challenges and opportunities. But we're seeing the return of the inverse, which does suggest a return to more stable and normal conditions. And generally, and this is kind of why I opened with, we're seeing sentiment improving. We're starting to see some of the deal flow open up a bit more and investment interest resuming within businesses. And I would expect that as we get into 2024 proper, that's only going to accelerate. So what does that tell us then? If we think about those last several years, why is that review important? And where we're seeing it show up is in the conversations people are having again about whether that they're looking at selling, buying, or simply looking at how to invest in their business. But we're going to take it through the lens of if you're an acquirer or a potential seller. Traditionally, if you're an acquirer and you're looking at buying a business, much of your focus was on the audited financials, the numbers that business had produced, and maybe the quality of earnings. What's the reliability and the validity of that information? So that look at past performance and the validity of the information was king. Financial due diligence was the evaluation part of a deal making. Is this a deal worth pursuing? And I'm being very general here, but once you got past the financial due diligence, then you gave a secondary look in what we often call operational due diligence, how the business is run, and commercial due diligence. How well positioned is that business? What's the outlook for that marketplace? What's the positioning and pricing and product portfolio, et cetera? And so in my reading of history, financial due diligence, again, was the evaluation portion of looking at a business, while operations and commercial were largely confirmatory. They were a way to identify if there's any major issues that required your attention, but they were largely there to confirm that what you had already concluded from financial due diligence was true. What we're seeing now is you look at the last several years, buyers and lenders and investors, they want to look out the windshield. They don't want to spend all their time looking in the rear view. And that previous approach that I just summarized is largely a look in the rear view. And so as we go forward after the past several years, demonstrating the ability to produce the results that you had in the past in the future is becoming incredibly important. And from a buyer's or investor's perspective, and the reason that we all need to be thinking about this is that demonstrating the ability to produce similar or better results in the future de-risks investment. It de-risks partnerships. It de-risks investment, acquisition, et cetera. And it provides a look at how the company is run, what they did to generate the past returns. We know what the returns were, but as you look at all that volatility over the last 4 to 5 years, you got to say, okay, well, those numbers are interesting, but I want to know how they did it. Because if I know how they did it, then I can make a more informed conclusion on how likely they are to do it again in the future. And this builds a more comprehensive view on the prospects of that business, particularly as we enter this period of normalization. So we all know that the phrase past performance is not indicative of future success. We all have heard that from the investing community, and if you're buying mutual funds for your retirement portfolio, et cetera. But we need to go beyond that. The last 3 or 4 years are in many ways, for many of our businesses, somewhat immaterial or maybe even meaningless to actually understanding what are the future prospects. Because I would contend that we're unlikely to repeat the conditions of 2020 through 2023 anytime soon. If we can't repeat those conditions, what we're left with is how do we operate? And so in more and more instances, what we're observing through the questions that folks are asking is there's a real scrutiny of the credibility of forward projections. How likely are you to succeed going forward? What are the ways in which you operate? And so that's what I want to talk about today. And this is where we're going to talk about the 5 things that we are recommending to our clients, and frankly, the things that we are hearing from the marketplace that are going to be among the most important for a firm to demonstrate their ability to execute. And the thing I want to draw through here is, if you're a buyer, this is what you want to focus on as you evaluate a target. If you're a seller, this is what you want to focus on in order to optimize the value at your exit. And if you're neither of those, or you don't know if you're going to be either one of those, these are the things that are just good blocking and tackling back to the basics, the return of rationality, the ways we need to run our business. And in times of unprecedented volatility, with all sorts of instability in the supply chain and the marketplace, with artificially inflated or suppressed marketplaces, you think about all the money and the little to no interest on borrowing and just all the disruptions we've had, it's really easy to move away from the basics. And so it's incumbent upon us to focus on these. And there's 5 of them. It's strategy, process, talent, technology, and investment. And so let me just talk about each of those for just a couple of minutes here.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
The first thing I want to say about strategy is a strategy is no longer enough. Telling a compelling story doesn't get it done. We need to be able to say, this is our strategy, this is what we're going for, and then it needs to be buttressed with explicit focus areas. These are the things we're doing to drive that strategy forward. These are the levers that we're going to pull. We need to build those clear links between those focus areas and value creation. What is the expected outcome of pulling that lever? And then how does that value creation align back to the strategy? And then we also need to have defined metrics. So here's our strategy. Here's the story we're telling ourselves and telling the marketplace. Here's where we're focusing. Here's the value they're going to create. And here's how we're going to measure and know that we're doing it well, that we're getting the progress and the impact that we expect. Investors and inquirers are going to have less and less appetite for ambiguity, for experimentation, for big promises without a lot of details around how you're going to get there. And so I think it's also incumbent upon owners of businesses that aren't in the transaction space to be thinking about this as well. Is our strategy big and bold? Does it make us uncomfortable? But does it also have some meat on the bones where we can say explicitly, here's how we're going to execute. Here's how we're going to create value. And here's how we're going to know if we're doing the right things and making progress. The second, then, of course, is process. If we think about process and we think about from a transaction standpoint, let's use the example of home buying. Traditionally, you put a house on the market and it's got a list price, you've got some pictures, you've got some information about the upgrades that you've made, school district that's in, the historic taxes, the neighborhood amenities, whatever that might be. And then buyers come in and they do a tour of the home. That tour of the home, which is largely superficial, is kind of like what the financial due diligence was before. Show us the numbers, show us the upgrades you've made, show us the fixtures and finishings that you've installed, give us the information we need to kind of evaluate if this is a house we want to buy. But that's not enough anymore. We talked about the operational and commercial due diligence. Now those same buyers, when they walk through the house, they want to open the walls. They want to see how it's wired. They want to check the plumbing. They want to measure the installation. They want to see the studs. They want to know how the house was built and what kinds of materials were used. And so when you think about this from the context of your business, this gets down to process. Being able to answer questions for yourself and for others of what are your core processes? What are the things that you do that create value in your business? That's a question that creates a great deal of clarity for the business when you answer it. But many businesses, if you walk in and say, hey, what are your core processes? They may have an answer for you, but it's likely a bit scattered. And it's maybe not the exclusively value-added processes that you do differently than everybody else, which is how you create outsized value. So beyond what are your core processes, you also should be able to answer the question of how do they work? What is the process? Do you have a process? Are they people dependent? Is this process that's improved over time through refinement, or is it largely because an individual's been doing it for 20 years and they just know how to do it and they're super detailed and that's a person that just doesn't make mistakes? That's a pretty important thing to know about your core processes. People are going to want to know, how do you know if your process is working? Can you predict drift? Or do you actually need to wait for some off-spec product to be produced and hit a customer's dock, or an actual incorrect order fulfillment? Or do you need to wait for an operational incident, a safety incident, or a chemical release, or some other issue? Do you need to wait for those to happen before you discover that there's been drift in your processes? Or do you have predictive ways of knowing if your core processes are working? People are going to want to know, what have you done recently to improve your processes? Show us where you're investing time and attention to actually become more efficient. Yeah, of course, from a cost perspective, but also effective from a value perspective. Doing this process as effectively as possible to get the maximum impact and upside. And they're going to want to know, what else do you have planned? So what are your core processes? Tell us about how they work. How do you know they're working? Are you improving them? And what's next on the docket? Those are the things that buyers, investors want to look for. And frankly, those are the things that I would remind even operators that are not looking at a transaction to look at closely. Can you answer those questions? And where you can't, or where you struggle to answer them, what does that mean for what you need to be doing going forward? The third thing is the state of talent in the business. So we've got a couple of compounding factors here. We know we've got labor challenges, right? There's not as many people working or wanting to do some of the work that's required within our businesses. We've got immigration challenges. There's just not enough talent out there. Additionally, people are calling it the silver tsunami, so I'll just, build onto that or jump on that bandwagon for the moment. But we have this historic wave of retirements coming ahead of us. So people with many years of experience that have seen the good times and the bad, they've seen the cycles of the business, they're going to be stepping away. That's going to compound the talent challenges that we're going to experience. And so as you look at the state of talent in your business, you need to think about, do we have a moat around our best people that's going to engage and retain them? Do we have a way to manage the key man risk? And I don't want to be gender specific here. It should be key person risk, but the insurance product is key man risk. Are there individuals in your business where if they left, it is perhaps catastrophic to the future prospects of your organization? And what are you doing to either mitigate or outright prevent that from being the case? Do you have retention plans in place for your best people? Do you know who your best people are in a clearly quantified, measurable way? What does your talent pipeline look like? Do you have succession plans built? Are you working those succession plans? These kinds of things, saying that you know that you have some defense mechanisms around your best people, that you understand who your key people are and you've got plans in place to mitigate the damage from them potentially leaving. You've got retention plans. You've got an assessment of your pipeline. You have succession plans. All of these things build the value of your company, whether you're looking to sell or whether you're looking to execute strategy and you want to have confidence so that from a people perspective, you're covered. So ask yourself this question. Do you have culture and processes that are attracting the best people and retaining them? Or is it attracting and retaining the worst people? So really give some focus to the state of talent in your organization. The fourth item here is technology. What I will say is that the level and maturity of technology adoption tells employees, tells customers, tells the marketplace a lot about your organization. There's an expectation that we are all driving efficiencies and widening our margins and reducing our errors, and frankly, just producing generally better outcomes through the use of technology. So from a transaction perspective, this is going to look like, do you have an ERP or an enterprise resource planning technology solution in place? If you do, there'll be some discussion around how well is it working for your organization, but the more impactful discussion is going to be, is it right-sized for growth? Can you grow with that solution? People are going to want to know, they're going to look at how have you deployed automation in your production environments? What are you doing maybe to address labor shortages by automating some work, but what are you doing just to make work perhaps less risky, less dangerous, less miserable in some contexts? What kind of automation investments are you making? Where have you automated workflows for some of those routine, maybe lower value back office tasks, the things that just have to happen in the background? Invoice matching, for example. Flagging, rather than having someone run through a list of transactions to flag the ones that seem like they're non-compliant or require secondary review, having workflows that flag those things for additional scrutiny automatically and kind of using technology in that way. So again, the level and maturity of technology adoption is going to be really, really important. And the fifth and final thing is investment. And specifically here, I mean investment rigor and discipline. Investment in a business is expected. If you were looking to buy a new home or buy a new vehicle, if you see a neglected home where they have not been mowing the lawn, they haven't put a fresh coat of paint on in a long time, it doesn't look like they've been doing any interior sort of maintenance activities, it's generally a state of neglect, or all those same things for a poorly maintained vehicle. It's got an oil leak, the interior's dirty, the tires are worn, there's not much tread left. All of those things contribute to the universe of potential buyers getting much, much smaller. And that smaller universe of buyers is going to extract some heavy discounts. But this is impactful also if you're not selling, because all these things, this lack of investment, this lack of maintenance in your business is really signaling that there's a general atrophy in your readiness to compete, in the muscle memory of getting stuff done in the business. The business is getting tired. It needs that juice. It needs that help to get it going. So it's really important to remember that a lack of investment doesn't really signal frugality. A failure to invest in your business, from my perspective and from what we hear from the marketplace, failure to invest, it rather than frugality, it suggests that there's maybe a lack of vision, a lack of energy, or a lack of conviction that your business is something that's worthy of that investment. And that just introduces all sorts of long tail risk for future prospects. So the kinds of questions people are going to ask and questions you should be asking yourself is, do we have a multi-year investment thesis? Do we have a sense of how much capital we would like to deploy? Not saying you will deploy, but how much you would like to deploy over the next 3 to 5 years. Do you have processes in place to ensure that those investments would be aligned to your strategy? Again, those focus areas, those things that create value and how you're measuring them. We talked about at the start with strategy. Are those showing up in how you invest? And then also, can you demonstrate for yourself or others that the investments you executed in the past went well and how they actually performed relative to what your expectations are? We all have projects in our past where it was a great idea. We had a lot of excitement. We fought through it. There was all kinds of maybe shortcomings and some wins, but we got it done. We moved on to the next thing. And if you went back now and said, what was the business case for that project? You might struggle to find it. And if you did find it, you say, okay, how well did we do against expectations? Many of us, if we're being honest with ourselves, would really struggle to get there. And so just to recap then again, strategy, process, talent, technology, investment, these are the things that demonstrate your ability to execute. These are the things that will demonstrate your ability to reproduce past results into the future, agnostic of the environment that you're operating in. So we covered a lot of ground today, and I thank you for hanging in there and sticking with it, and I hope it's of value to you. But let me recap again, just very briefly, what we talked about. We looked at the last several years from 2020 until the year ahead of us, 2024. We looked at the last several years and talked about all the historic volatility and instability that's been thrown at us. We talked about how, as a result, what investors and bankers and partners are going to be looking at in terms of performance, how their evaluation of performance is evolving, and it's evolving for the better. And we talked about how you're going to need to be prepared for a renewed and more finely tuned assessment, both looking inwardly as well as expecting it from the marketplace about your strategy, your process, state of talent, technology adoption, and investment. So thank you as always for listening in today. I really appreciate you spending the time. I don't take it for granted. A reminder to like and subscribe to the Pacesetter Pod wherever you get your podcasts, and a reminder that you can also get in touch with me, Joe Mosier, on LinkedIn, or you can visit us on our website at www.mosiercg.com and set up a call with me directly. Thank you, and have a safe day.
This is thepodcastfactory.com.